What most Americans don't realize is that the foundation of their economic power isn't military might or industrial capacity, it's trust. Trust that the dollar will hold its value tomorrow. Trust that American financial institutions will honor their commitments. Trust that Washington won't weaponize access to global markets on a political whim. And when that trust begins to erode, the collapse doesn't announce itself with dramatic headlines. It happens quietly, methodically, through the kind of technical adjustments that central bankers understand but politicians rarely notice until the damage is already done. I've spent decades watching how financial power actually operates, and what we're witnessing now between the United States and Canada represents something far more consequential than a trade spat or diplomatic friction. We are watching the deliberate, methodical dismantling of dollar dependence by one of America's most trusted financial partners. And the architect of this strategy is Mark Carney, a man whose resume reads like a blueprint for exactly this kind of operation. Most people see Carney as a soft-spoken technocrat, the kind of central banker who puts audiences to sleep with discussions of monetary policy and inflation targets. But those of us who understand how global finance actually works recognize something much more dangerous. This is a man who has run the central banks of Canada and Britain, who has sat at the table when the world's most powerful financial institutions make decisions that reshape entire economies. When someone with that experience decides to challenge American financial dominance, it's not a temper tantrum. It's a calculated assault on the very structure that keeps the United States at the center of the global economy. The public story, the one you've probably been told if you've been paying attention at all, is relatively simple. Canada is upset about tariffs, trade disputes, and what they see as disrespectful treatment from Washington. Prime Minister Carney has been pushing back against American pressure, refusing to give in to demands for immediate concessions, and generally behaving like a country that doesn't recognize its junior status in the relationship. From the American perspective, this looks like stubbornness, maybe even ingratitude from a neighbor that has benefited enormously from proximity to the world's largest economy. But that surface narrative misses the deeper technical reality of what Canada has been doing behind the scenes. Over the past several months, Canadian financial institutions have been quietly but systematically reducing their exposure to dollar-denominated assets. Not dramatically, not in ways that would trigger immediate market alarms, but steadily and with clear strategic intent. Central bank reserves that were once heavily weighted toward U.S. Treasury bonds have been diversified into European sovereign debt, Asian development bonds, and even experimental positions in digital currencies backed by resource-rich nations. The mechanism is sophisticated, but the logic is simple. When a country holds large reserves in your currency, they are essentially lending you money and trusting that you will manage your economy responsibly enough to preserve the value of their holdings. It's a form of financial interdependence that gives both sides leverage but also creates vulnerability. Canada has decided that the vulnerability outweighs the leverage, and they are acting accordingly. What makes this particularly dangerous for the United States is the demonstration effect. Canada isn't some developing nation with a history of financial instability and questionable institutions. This is one of the world's most stable, predictable financial systems, run by people who understand global markets as well as anyone in London or New York. When a country like that starts diversifying away from dollar dependence, other central banks pay attention. They ask themselves whether they should be doing the same thing. I want you to understand how this process actually unfolds, because it's not the kind of thing that shows up on cable news or generates viral social media posts. Central banks operate with long planning horizons and institutional patience. They don't make dramatic announcements about currency warfare or financial retaliation. They simply adjust their portfolio allocations, shift their trading relationships, and gradually build new infrastructure that reduces their reliance on American financial institutions. In Canada's case, that infrastructure building has been remarkably thorough. Canadian banks have expanded their correspondent relationships with European and Asian institutions, reducing their need to clear transactions through New York. The Bank of Canada has been exploring direct currency swap arrangements with the European Central Bank and the Bank of Japan, creating pathways for trade that bypass dollar intermediation entirely. None of this requires hostile rhetoric or dramatic gestures. It just requires technical competence and strategic patience, both of which Carney possesses in abundance. The institutional reality here cuts against everything Washington has assumed about the relationship. For decades, American policymakers have operated on the premise that dollar dominance was essentially permanent because the alternatives were inferior. The euro was too young and politically unstable. Asian currencies were too controlled or volatile. Smaller countries didn't have the scale or sophistication to challenge American financial infrastructure. That calculation was always more fragile than it appeared. Financial dominance isn't like military power, where overwhelming force can compel submission. It's more like a network effect, where the system works because everyone agrees it works. Once that agreement starts to fracture, the advantages can disappear faster than most people anticipate. Carney understands this dynamic better than almost anyone alive because he's operated at the center of it for his entire career. As governor of the Bank of Canada during the 2008 financial crisis, he watched how quickly confidence can evaporate and how devastating the consequences can be when trust breaks down. As governor of the Bank of England, he managed the financial complexities of Brexit, learning how political disruption translates into economic instability and how markets punish uncertainty. Now, as prime minister, he's applying those lessons in reverse. Instead of defending financial stability against political chaos, he's using political pressure from Washington as justification for reducing financial integration. Every time the United States threatens economic retaliation, Canada can point to the need for financial diversification and risk management. Every tariff, every insult, every demand for immediate concessions becomes evidence that relying too heavily on American financial infrastructure is dangerous. The broader strategic implications of this shift extend far beyond bilateral relations between the United States and Canada. We are watching the emergence of what economists call a multipolar financial system, where no single currency or set of institutions dominates global transactions. This is something American policymakers have feared for years but never quite believed could happen because they assumed the alternatives were too weak or fragmented to pose a real challenge. That assumption is being tested in real time. The European Union has been building financial infrastructure designed to reduce dollar dependence since the 2008 crisis, motivated partly by regulatory disputes and partly by concerns about American unilateral sanctions. China has been developing its own international payment systems and encouraging trading partners to use renminbi for commodity transactions. Russia, Iran, and other countries subjected to American financial pressure have created alternative clearing mechanisms that bypass Western institutions entirely. What makes Canada's participation in this trend so significant is credibility. When unstable or adversarial countries challenge dollar dominance, American officials can dismiss it as desperation or ideology. When Canada does it, the message is different. It says that even close allies and stable democracies are concluding that dollar dependence is a strategic liability. The market reaction to these shifts has been subtle but persistent. Currency traders have begun pricing in what they call de-dollarization risk, the possibility that demand for dollars will decline as other countries build alternative payment systems. Interest rate spreads between U.S. Treasury bonds and comparable foreign debt have narrowed as international demand for American assets weakens. Most importantly, the dollar's share of global foreign exchange reserves has been declining gradually but consistently, a trend that accelerates every time Washington uses financial access as a political weapon. Wall Street understands these dynamics even if Washington doesn't. Major banks have been quietly preparing for a world where dollar dominance is less absolute, investing in foreign exchange capabilities, building relationships with non-American financial institutions, and hedging against the possibility that U.S. markets will become less central to global finance. This isn't panic. It's prudent risk management in response to political decisions that make the financial system less stable and predictable. The human cost of this transition will be borne primarily by Americans who never participated in the decisions that triggered it. When global demand for dollars declines, it becomes more expensive for American businesses to import goods and more difficult for American consumers to travel abroad. When foreign central banks hold fewer treasury bonds, the U.S. government faces higher borrowing costs, which eventually translate into higher taxes or reduced public services. Perhaps most importantly, when the dollar's special status erodes, American financial institutions lose their unique advantages in global markets. New York's role as the world's financial center becomes less secure. The fees, commissions, and spreads that have enriched American banks for generations begin flowing to competitors in London, Frankfurt, Singapore, and other cities that offer greater stability and predictability. This is where Carney's background becomes a decisive advantage. He knows exactly how these systems work because he's operated them at the highest levels. He understands which institutions are vulnerable, which relationships can be redirected, and how to build alternative networks without triggering the kind of dramatic retaliation that would strengthen American resolve. More fundamentally, he understands something that Washington seems to have forgotten. Financial power depends on cooperation, not coercion. When you try to force compliance through threats and pressure, you provide exactly the motivation other countries need to reduce their dependence on your system. Every sanction, every freeze of assets, every demand for political submission teaches the world that American financial infrastructure is a weapon that can be turned against them. The tragedy of this moment is how avoidable it was. The United States built the post-war financial system by offering stability, predictability, and mutual benefit. Countries participated not because they had to, but because it made them more prosperous and secure. That foundation could have lasted for generations if it had been maintained with the kind of institutional wisdom and strategic patience that once characterized American leadership. Instead, we have witnessed the systematic erosion of trust through impulsive decisions, contradictory policies, and the treatment of allies as subordinates rather than partners. Carney's response isn't emotional or ideological. It's a rational adaptation to a United States that has become an unreliable steward of the global financial system. The most unsettling aspect of this crisis is how little attention it receives from American political leadership. While media cycles focus on dramatic confrontations and personal grievances, the foundational structures of American power are being quietly dismantled by competent professionals who understand how these systems actually work. By the time the consequences become visible in daily life, the damage will be largely irreversible. Currency dominance isn't something you can restore through military pressure or economic threats. It's built on decades of consistent behavior and destroyed through years of erratic decision-making. Once trading partners develop alternative systems and institutions, they don't typically abandon them when political conditions change. They keep using what works and gradually reduce their exposure to what doesn't. This is the deeper lesson of Canada's financial strategy. It demonstrates that American power was always more conditional and fragile than its practitioners understood. When that power was exercised with wisdom and restraint, it seemed unshakable. When it's exercised impulsively and aggressively, it reveals itself to be dependent on the voluntary cooperation of partners who are perfectly capable of making other choices. History rarely punishes nations for losing power naturally through changing circumstances. It punishes them for accelerating their own decline through the arrogance of believing that dominance is permanent and that trust, once lost, can be restored on demand. What we're witnessing is not Canada's betrayal of the relationship, but America's betrayal of the principles that made the relationship valuable in the first place.